If you only have 10,000, don't invest until you watch this. You just checked your account. $10,000 sitting there. Maybe it's a bonus. Maybe it's a graduation gift, a settlement, a tax refund you weren't expecting, or 3 years of quietly not spending money you didn't have to spend. However it got there, it feels like the beginning of something. It feels like the moment you finally become an investor. So you open an app, Robinhood, Fidelity, whatever your cousin told you to download. You type in a number, 9,000 maybe. You leave 1,000 for, just in case. You pick something, an index fund, a stock you saw mentioned online, maybe something with a dog on the logo. You hit buy. And here's what nobody in that moment tells you. You just made a decision that has almost nothing to do with your future wealth. Not because the investment was bad, because the order was wrong. $10,000 invested at the wrong moment, in the wrong sequence, isn't the start of wealth. It's a loan you gave to your future self at an interest rate you don't control, that you're statistically likely to cancel early, at the worst possible time, for less than you put in. Here's the turn. The question was never, what should I invest in? The question is, what order do I do things in? And almost everyone gets the order backwards. $10,000 isn't one situation. It's at least 5 different financial identities wearing the same bank balance. The first carries $4,000 in card debt at 2% interest, and the 10,000 feels like an escape hatch. Except it isn't, because the debt is still compounding against them while they daydream about compounding for them. The second has 0 debt, but also 0 emergency fund. 1 car repair, 1 missed paycheck, 1 broken tooth away from having to sell whatever they just invested in, probably at a loss, probably in a panic. The third has a job with a 401k match sitting complete unused. Free money their employer is offering, dollar for dollar, up to a limit that they simply aren't collecting, while they open a brokerage app instead. The fourth has the emergency fund, has the match, has no debt, and is genuinely, for the first time, in a position where the $10,000 is actually investable money. The fifth, and this one surprises people, has all of the above handled and still loses money because of the market, but because of behavior, panic selling, chasing trends, checking the balance daily until anxiety forces a decision. 90% of people watching this video are one of the first 3. This video is for figuring out which one you are before you touch that $10,000 again. Here's why that identity matters more than the investment itself. A financial plan that's perfect is actively dangerous for the first person. Telling someone carrying high interest debt just cost average into an index fund is like telling someone with a leaking roof to focus on redecorating the living room. The furniture might be beautiful, the house still full. Wealth building advice isn't universal, it's sequential, and it only works when it's applied to the right identity at the right stage. When you invest $10,000, you think you're buying shares, a piece of a company, a number that goes up. That's the label on the box. Here's what's actually inside it. You're buying exposure to volatility, the willingness to watch that number drop 20, 30, sometimes 50% and do nothing. You're buying a time horizon, an implicit bet that you will not need this specific money for a specific number of years, because withdrawing it early doesn't just cost you the gains, it can cost you principal. You're buying a tax relationship. Every investment account has an agreement with the government about when you get taxed, how much, and what penalty applies if you break the agreement early. Most first-time investors never read the agreement. You're buying fees, some visible, most invisible. Expense ratios, a trading spread, account maintenance charges that actions over 7% off your return every single year, forever, whether the market goes up or down. And you're buying a version of yourself under stress, the you that exists when the market drops 15% in a week. That version of you is the one who actually determines your return, not the fund manager, not the ticker symbol. Nobody sells you that on the app's front page. That's what you're actually purchasing with $10,000. Every one of these is invisible on the confirmation screen. The screen just says hoarder filled. It doesn't say, I've now agreed to feel nothing when this number drops by a third. It doesn't say, you have now agreed not to need this money for at least 5 years. Those agreements exist whether you read them or not, and they're the actual product being sold. Let's put real numbers on the foundation you need before that $10,000 should touch an investment account. An emergency fund, properly sized, is 3 to 6 months of essential expenses. For a household spending $3,000 a month on rent, food, insurance, and transportation, that's $9,000 to $18,000 sitting in cash, earning almost nothing, doing almost everything, because it exists as the single most important financial asset you own. Credit card debt at 22% interest, mathematically a guaranteed negative 22% investment. Paying it off is the same as finding investment with guaranteed, tax-free 22% annual return. No index fund promises that. No stock promises that. Paying down that debt is the highest return investment available to almost anyone, and it's the one people skip past to buy something with a stock ticker instead. An employer 401k match. A common structure is 50 cents on every dollar you contribute, up to 6% of your salary. On a $50,000 salary, that's $1,500 a year free money, not invested and hoping it grows money. Guaranteed the moment it hits your account, money. So before a single dollar goes into a brokerage account chasing 8 or 10% average annual returns, there are guaranteed returns of 20%, 50%, and the irreplaceable value of not having to sustenance in a panic, sitting right there, unclaimed. And it's worth sitting with why these numbers get ignored. A 22% guaranteed return doesn't feel like an investment because there's no chart, no ticker, no green arrow to screenshot. Paying down a balance is invisible progress. It doesn't trigger the same dopamine as watching a portfolio tick upward in real time, but the math doesn't care how it feels. A dollar not paid in interest and a dollar earned in the market spend the same. So where does the $10,000 actually go first? Follow it upstream, one layer at a time, the way money actually should move, not the way app wants it to move. Layer 1, a high interest debt. Anything above roughly 7 or 8% interest. Credit cards, some personal loans, gets paid down first. This is math. You cannot reliably out-earn 22% in the market, so the debt has to go. Layer 2, a starter emergency fund. Not the full 3 to 6 months yet, just $1,000, sometimes called the shock absorber. Enough to cover a flat tire or a broken foot, reaching for a credit card and undoing layer 1. Layer 3, the employer match. Contribute enough to your workplace retirement account to capture the full match, and not a penny less, because leaving it unclaimed is identical to declining a raise. Layer 4, the full emergency fund. Now build out to 3 to 6 months of expenses in cash in a high-yield savings account, untouched. Layer 5, everything else. Remaining high interest debt gone, additional retirement contributions, and finally, a taxable brokerage account, the $10,000 moment you started this video imagining. This is the stack. Money moves up it in order, skipping a layer to get to investing faster to accelerate your wealth. It just means you built layer 5 on top of nothing, and the first financial shock knocks the whole structure down. Notice what's missing from this stack. There's no layer that says pick the perfect stock or time the market bottom. Those decisions matter far less than most people assume, and they only matter at all once the first 4 layers are solid. The stack isn't exciting. It doesn't make for a dramatic screenshot, but it's the difference between money that survives contact with real life and money that doesn't. Here's the part almost nobody says out loud. The biggest driver of whether that $10,000 turns into real wealth has almost nothing to do with which stock, which fund, or which app you chose. It's whether you ever had to sell. Picture 2 people. Both invest $9,000 in the exact same index fund the same day. Person A has no emergency fund. 6 months later, their car transmission fails on $1,800 repair, and the market happens to be down 12% that week. They sell shares to cover it, locking in the loss, and they never fully re-enter because now they're scared of the market. Person B has the 6-month emergency fund already built. The same transmission fails. They pay from cash. Their $9,000 stays safest, untouched through the dip and through the recovery. Same starting amount, same market. Radically different outcome, and the difference wasn't investment skill. It was a cash cushion that meant they never had to become a forced seller. This is the real, unsexy profit center of personal finance. Not having to sell is worth more than knowing what to buy. Call it the non-seller's advantage. The entire difference between people who build wealth from $10,000 and people who don't. And it has nothing to do with the fund they pick. The emergency fund isn't separate from your investment returns. It is your investment returns because it's the thing that keeps your money invested long enough to compound. Think about what actually happened in that comparison. Person A didn't lose money because they were bad investing. They lost money because their car broke down at an inconvenient time, which is another way of saying they lost money because life happened, and life always happened. The market crashing isn't the risk most new investors should fear most. The risk is being forced to sell during the crash, and that risk is entirely solvable with cash sitting in a separate account, doing nothing, waiting for exactly this moment. Even once the foundation is built, there are quiet leaks most new investors never notice. Fees compound too. A fund charging 1% a year versus one charging 0.03% doesn't sound like much. Over 30 years on the same $9,000 starting balance, that difference alone can cost tens of thousands of dollars. Money that simply evaporates into someone else's management fee. Taxes have timing. Selling an investment before you've held a full year triggers short-term capital gains, taxed like ordinary income, sometimes double the rate of a long-term gain. The account type matters just as much as the investment. The behavior gap is real. Studies on investor returns consistently show that the average investor earns meaningfully less than the very funds they're invested in, not because the fund underperformed, but because the investor bought high, sold low, and bought high again, chasing their own emotions instead of holding still. None of these costs show up on the app's home screen when you tap buy. They show up 10 years later, in the gap between what the market returned and what you actually kept. There's a fourth leak too, quieter the rest, life deal creep disguised as investing. Some people treat a brokerage account like a savings account with better branding, pulling money out for vacations or upgrades whenever the balance looks healthy. Every withdrawal resets the compounding clock on that money and resets it permanently. The account doesn't know the difference between a real emergency and a whim. Only you do. Out of everything covered, one single variable overrides almost all of it. Whether the money stays invested without interruption, not the specific fund, not the exact percentage in stocks versus bonds, not the app you chose. Time in the market, uninterrupted by emergencies, is the lever that is almost all of the heavy lifting. Two people can choose nearly identical investments. The one who never has to touch it, because the foundation underneath is solid, ends up with dramatically more money than the one who gets pulled out twice by life happening. This is the one variable that separates people who turn $10,000 into real wealth from people who turn it into a story about the time they lost money in the market. Let's make this concrete with one number. $9,000 invested in a broad index fund, left completely untouched for 30 years, at a historical average return of roughly 7% after inflation, grows to somewhere around $68,500. Not because of a clever stock pick, because it was never interrupted. Now take that same $9,000, but the investor gets forced to sell a third of it during a market dip in year 3 to cover an emergency, and enters 2 years later after missing the recovery. The ending balance isn't $68,500, it's closer to $41,000, a gap of over $27,000, and the fund was identical the entire time. That gap wasn't caused by a bad investment, it was caused by a missing emergency fund. Run the same comparison at $50,000 or at $500,000, and the shape of the gap doesn't change, only the size of it does. The mechanism scales with every dollar you ever invest for the rest of your life, which means the habits you build around this first $10,000 aren't a one-time decision. They're the template your money will follow for every dollar that comes after it. So go back to the account you checked at the start of this video. $10,000 sitting there, feeling like the beginning of something. It still can be, but not yet. Not until the debt above 8% is gone. Not until the employer match is captured. Not until 3 to 6 months sit in cash where the market can never touch them. Because the $10,000 that match is never the $10,000 you invest. It's the $10,000 you protect first, so the next $10,000 can compound without ever being pulled back out.